just wanted to provide an update on a particular video that I did some time back. So I've uploaded this video on the 5th of August 2022. That's around 4 to 5 months ago. And with the title Negative 600,000 on a $1 million portfolio. I mean, I have to confess, it's kind of a clickbait because it's not my portfolio. I was essentially trying to explain or trying to go through a particular blog post by this guy called Invest with Jason Tsai. And ironically, it gotten quite a lot of views. There was 8,000 of you that viewed the video, but that's it. We only had 201 likes. So if possible, let me try to plead to you guys again. Remember to help smash that like button. And of course, this is part 2 of the video where we will give an update on what exactly transpired to Jason's portfolio. And I think before I even go into the details or the meat of the discussion, I just wanted to preface this. The market hasn't been very kind to many investors, particularly in 2022. So likewise for Jason, I think there were many lessons that many of us investors can learn, especially when he's being so transparent. So rather than just leave nonsense comments, very insensitive comments in the comment section down below, you were not the one that had such great losses in the markets. Yet at the same time, you have this opportunity together with me through this video. We can learn from his journey, learn from his experience. And don't forget, he has the ability to earn that $1 million portfolio in the first place. If not, how can you lose X amount of dollars after we go through the details? So just keep that at the back of your mind. And of course, if I see any snarky remarks in the comment section, I wouldn't hesitate to delete or block you guys from my channel. So let's just try to keep it civil and keep the discussion tight and relevant in this place. So back to his blog post, I do recommend you guys to check it out. I actually do bookmark his blog post in one of my tabs because number one, he's being extremely transparent. Number two, he gives a lot of insightful reflections based on how he maneuver his portfolio. And number three, I think many of these lessons are very authentic and you actually get to learn a boatload. If you were to peel out from all the discrimination and criticism and whatnot that normal people on the internet do. Personally, I have deep reflections and there were many own personal lessons that I took away. Specifically when I also lost quite a huge deal of money in 2020 and 2021, especially when everybody was making money and everybody was essentially laughing at me because I was losing money in the markets. Funny enough, 2022 wasn't very bad for me. If you haven't checked out, I made a portfolio update then. But yes, let's go back to the main protagonist of this video. So for Jason's portfolio specifically, I think he made 3 specific updates and we'll be going through 3 specific articles. So the first one was actually uploaded on December the 11th, 2022. So he was essentially giving an update on his LEAPS portfolio. So for those of you who don't know what LEAPS are essentially long-dated call options, if I'm not wrong. They usually span in a duration of years, so it might be 1 year out, 2 years out, etc. So based on this December 11th update, it's down around 300 over 1,000. So what essentially happened? In my last update on 8th of October, I shared that my SGD 342,000 LEAPS call portfolio was down by 95%. While the Nasdaq has rebounded a little in the month of November, my overall loss has increased to 97% as the time decay eats into these option contracts. So Jason first bought all these LEAP calls contract back in 2021, with most of them expiring 1.5 to 2 years later. Back then, I thought that I was protected by the long expiration date and that there would be ample time for the stock market to recover. I was so wrong because time only gave the stock market more room to fall further and created new lows. After 1 full year of bear market in 2022, my call options are hit by both time decay as well as falling stock prices of once invincible sure-win stocks like Google, Meta, Nvidia and AMD. So the only consolation that I get is that if I were to lose 100% of this portfolio, I'm still able to break even and am better off than where I was when I started investing 10 years ago in 2012. However, this has not factored in the paper loss for my stock portfolio, though I do have holding power over them, provided they do not go bankrupt or permanently stay low when the stock market recovers. So I think in this specific example, when you're down like 95 to 97%, and if you were to really take a look at many of these names, Amazon, Alibaba, Bank of America, Disney, Google, I mean, I do own some of these names, right? In my portfolio, I have Amazon, I have Alibaba, I have Google, I have Meta. The issue here is that there are 2 main issues from this blog post that you really can learn. Number one, options is extremely dangerous. Number two, options is extremely dangerous. Okay, jokes aside, I think there are two core principles that you need to learn here. Firstly, when you are touching options, options is a time instrument. So this factor of it being a time instrument is extremely critical. So that's why I usually advise against buying both put and call options. If it's part of a grander strategy to hedge your portfolio, sure, so be it. If you know what you are doing, maybe you have a $1 million portfolio, you take out a 5% position, maybe 50,000, and you buy puts in order for it to act as a form of insurance. Go ahead. I know there are some people, especially in the Alibaba community, when Alibaba was essentially nosediving from 100 to 80 to 60, some of them bought some tail end like $40 strike Alibaba to essentially negate or hedge the portfolio. And it worked out quite well back then when Alibaba was just nosediving in October to $60. So what they did was they hedged the portfolio with a very, very obscure, very, very weird strike price where we know that Alibaba probably wouldn't hit. I think it was like $30 or $40 tail end. They're essentially trying to hedge the tail end risk. And then when Alibaba collapsed, the put option, the value of the premium of the put option suddenly spike up, and they managed to sell it out and just use the cash to, I don't know, buy more Alibaba shares or something like that. But that said, if you're not using it as a grander strategy, so you're basically just buying calls or buying puts just to bet on a particular market direction, then I think that's extremely dangerous, because you're essentially putting a directional bet, and we know that in the short term nobody knows where the stock market is going to move. And some of you might say, oh, you bounce back and tell me that, oh, 1 year, 2 year, where when you're buying leaps in this case, it has a 2-year expiry. You might think that it's a long enough timeline. No, I think 1 to 2 years is still considered short. By long timeline, at least in my definition or in my dictionary, long timeline it's at least 5, 8, 10 years. So that's the first point. Options is a time instrument and it's extremely dangerous. And number two is when you want to use when you want to adopt such strategy, which is buying leaps, you have to understand that the markets tend to be extremely irrational. So when we are locked in a bear market, it can remain in a bear market for a very long time. And I've took away this lesson since 2020 because I bought into Alibaba. My first position was end of 2020, around December. And look at where we are at now. Alibaba collapsed by 70% or even 80 something percent from its all-time highs, and the bear market just seems to never end. And the US market seems to be in the same cycle right now. And thankfully, I've gotten the lesson much earlier compared to people that all in many of these US stocks. And I think fundamentally, if you to look at many of these companies like Google, Disney, Amazon, all these are great companies. But why did the Leaps portfolio still go down by like 97%? It's purely because it's an option instrument. Even though you might have the holding power, because of time decay, in this case when time just marches forward and every day your options premium or the value of your options just slowly lose its price, even though the stock might not do anything. The stock might be flat or the stock might not even go up, because in this case, because you are buying a call, you long a lead. If the stock price just hold constant and it's below your strike price, you still just keep losing money. So that's the key area here. So this idea of using options as purely a directional bet, I think that's really a recipe for disaster. So 1 week later, on the December of 19th, Jason wrote another blog post. I closed all my remaining Leaps call position at a total loss of 415,000 Singapore dollars. So I finally did it. I closed all of my leap call position over 2 days on 13th and 15th of December at a total loss of around 333,000. There were contracts that I could not close because there were no more buyers, such as those expiring on January of 2023. I'll write them off as they will eventually expire worthless. Together with the 81,000 loss that I cut in August and September, the total loss that I cut for my entire Leaps call portfolio is around 415,000 Singapore dollars. So what a year and roller coaster ride it has been in this option trading strategy for me. So from being very confident that the market would eventually recover in 2022 when I built up a 453,000 calls portfolio, so to currently throwing in the towel and losing most of the capital invested, it was a very humbling experience. So I started buying the dip in December of 2021 with more expensive, longer dated call options, thinking that it will be enough to tide through the dips and pullbacks in 2022. When the market continued dropping, the war in Ukraine broke out, I was still in denial that things would eventually recover as the Fed would not crash the market, knowing it was a mid-term election cycle. So I was wrong as the rising inflation due to the various macroeconomic events such as the Ukraine war and China's policy led to the Fed aggressively increasing interest rate, which caused the prolonged bear market of 2022. So I had many chances to avoid such a huge loss of my portfolio throughout 2022 as the market continued to create new lows after last November's peak. But I held on to the faith that things would turn out eventually and the stock market would eventually rise to previous high. Due to the midterms election, seasonality, and the year-end Santa Claus rally. There were few rallies in March, June, August, and recently November. But after each one, the market went through a dead cat bounce and eventually crashed further. So before I continue on, remember to gently tap that like button in case you have forgotten. Introducing today's sponsor, Skillshare. So Skillshare is an online learning community with thousands of different online classes for all sorts of topics. They have a wide range of topics from personal finance to productivity and even how to start your very own YouTube channel. So like investing, I think the biggest asset in your life is not your stock portfolio or even your property portfolio. It's yourself. So you may know Skillshare for classes in photography, film, and even video editing. But did you know Skillshare has hundreds of career-focused classes too? So the new year is the perfect time to reinvent your goals and yourself. So there is no goal that is too small to achieve. And like everyone, I tend to procrastinate in my own free time. So right now, I'm taking a class from Thomas Frank with regards to productivity and how to build habits that last. So jumpstart your 2023 goals right now with this exclusive offer. So try Skillshare free for 7 days and then get 20% off your first year. Don't let this crazy deal go away so easily. Link in the description. Thank you Skillshare for sponsoring this video. Now, I think based on the initial commentaries, there were many of these discussions, particularly in 2022. And these are not wrong because many of them has data backing them up. So things like a midterm election cycle, that's why the stock market will go up, seasonality, Santa Claus rally. Many of these discussions, I actually see it on YouTube on multiple occasions by many different creators saying that, oh, there's a new high that's going to come. We are going to exit this bear market soon. But I would just like to say that past performances don't guarantee future results. So just by having it happen in the past, for example, it might even be 100%. So like many people assert, right? The S&P 500 over a 20-year rolling basis, it will definitely give you positive returns 100% of the time. That said, it doesn't mean that the S&P 500 for the next 20 years is going to guarantee you a positive return. You need to understand. You need to come to the conclusion yourself. What are the risks involved and who's providing this guarantee? So if you were to just look at the last 100 years, the Dow Jones, the S&P 500, over a trailing 20 years period, who is underwriting this return? It's essentially just market risk premium. And could US go through a lost decade or lost 2 decades? Sure, who's guaranteeing that? At one point in time, you have to reflect and tell yourself that, hey, I'm on borrowed time here. And unless you are holding on to stocks, and when you are holding on to stocks like myself, I can hold for a good 10, 20, 30 years. As long as the company doesn't go bankrupt, I probably wouldn't do too badly. And of course, when I buy it at cheap, I need to have that margin of safety and to buy it at a cheaper valuation. But as long as the company continues executing, there's earnings, there's free cash flow, the company is not a fraud, then I don't think it will do too badly. I think the really core problem here is this idea of timing. When you're playing with timing here, even though you might not want to sell, you might want to hold this position for a long time period, you might be forced sold out of your position. In this case, as leaps continue nearing its expiry, then you'll lose more and more of the premiums of that particular option. So why did Jason eventually choose to close all his leaps position? Firstly, all the economic events that could have turned the market have happened and they have not done anything to ignite the next bull market. Instead, things look bleaker than before. Even when data has shown that inflation is starting to fall, the Fed still thinks that inflation is not falling fast enough and will continue to hike rates into 2023. So the effects of the interest rate hikes will be felt in 2023 as companies will continue to retrench and cut costs as demand weakens amidst the recession. So this also means that company earnings will fall, which then inevitably affects its share price. With the Fed's continual tightening, the economy could go into stagflation, which is a double whammy of both inflation and economic stagnation. So lastly, if I were to cut my cost a few months ago, I would end up with a huge net loss after 10 years of investing and options trading. It was with the profits earned in the later months that I managed to break even on my overall investment, as my profits over the last 10 years cover the total loss of the worst case scenario of my Leap's core portfolio collapse. So that gave me the courage to cut the remaining 334,000 losses. So I'll be sharing the lessons that I've learned after losing more than $500,000 in the stock market over 10 years in a future post, so do stay tuned. If you have lost a lot of money in this year, I hope my sharing provides some comfort that you are not alone and there is always a chance to turn things around if you do not give up. Now, at the end of the year, he then revealed his entire $609,000 portfolio, and just to give you a teaser on how it looks like. So one of the biggest lessons that I learned in 2022 is to expect the unexpected and be prepared for the worst case scenario. So after cleaning the big baggage that I carried for the year in 2022 and taking a huge loss on my Leap's core options portfolio, I felt lighter now and ready to take on 2023 with a new plan and strategy. So this is his current funds allocation. You can see that the total amount now is still around 609,000 with an unrealized loss of around 321,000. So based on the current standing, I think his portfolio is worth around 288,000. And on that note, from his $1 million portfolio, I think it's down around 70%. So my previous $1 million portfolio is down by 40% after I sold off my remaining Leap's core position. And the current net liquidity, aka surrender value, would be 288. So my current capital allocation is divided into 3 portfolios: stocks, options, and fixed income. So I'm planning to keep my funds for options trading to just 10% of the total portfolio allocation, which means that if I were to lose it all in another disaster, I will only be 10% down on my total capital. Currently, it is only 3%, which means I can allocate more funds to this portfolio in 2023. So in 2022, I allocated around 45% to options trading, and that was a big mistake as I eventually lost a bulk of them through the prolonged bear market of 2022. And I think I'd just like to caution this. I totally agree this format. I know everybody has kind of that itchy fingers, right? They want to do something. They think that if they're not doing anything, they're not contributing positively to the portfolio. In theory, it doesn't make any sense because all of us should be long-term investors. We should just buy fundamentally good companies and just research and just sit on our shares. But I do understand on the emotional side of things, people want to do something. And personally for me, it's the same. I also like to trade in and out of options, but personally I only sell puts. I did sell calls from time to time, but when I thought that the price was low, when the valuations don't make sense, I won't sell call. So I will only sell call when the position actually balloons to a certain figure, and I think that there is a good enough margin of safety and I can take profits on that particular position. So I've been selling a lot of puts. I've been playing around with a lot of time decays and if it's up 20-30% within like one week or something, and then I'll just sell it and realize the profit. And I would just like to point out that options trading is not risk-free, by the way. I don't know how, I don't know when, but some of my friends are telling me that, trading options is like free money. There is nothing in this world that is free money. You just need to know what kind of risk you're taking. And particularly so if the reward is extremely high, so like if you can get easily a few $1,000s a month, then you have to keep in mind what exactly is the risk that I'm taking. Why is it so good that I can earn a few $1,000s a month just by clicking a few buttons in my portfolio and my brokerage account, thinking that I can get free money from somebody? You need to understand that by writing an option, in this case, which is what I'm doing, by writing an option or by selling an option, somebody is willing to pay me that few $1,000s to underwrite the risk that I'm going to take. So is there really free lunch in this world? I think I'll just leave that thought for you to decide. But I'd just like to say that yes, I've been quote unquote burned before. So I've been assigned companies at extremely high strike prices because I basically screwed up. And yes, I think in my previous portfolio update, I did say that I'm kind of on slight leverage because I was assigned 998HS, which is Alibaba in the Hong Kong exchange, prematurely. So just keep that in mind. So just in case things go south, you must have a wet weather plan and you must have an emergency plan. Long story short, you need to know what you're doing. So I'll just leave it as that. So I won't proclaim that I'm an options expert here, but I kind of know what I'm doing. So I'm okay with that level of leverage, or I'm okay with that level of risk that I'm taking when I'm selling puts. So That's that. So in the meantime, my US stock portfolio, less Alibaba, is doubling up for me to sell covered calls to generate some returns periodically. So I'm also slowly DCing into SPY because I think that's the safest stock in my entire portfolio. So the ETF for the 500 biggest company in the US itself is self-cleansing and will have almost zero chance of bankruptcy. I hope to accumulate at least 100 shares over the next year for me to use as collateral to sell covered calls options. So in terms of its options portfolio, with the above stock as collateral, these are the current open covered call options position. So he sell covered calls on Tesla, Nvidia, NIO, AMD, Palantir, and more Tesla. Personally, I don't really see a very big problem with it. I think in terms of price action wise, many of these companies, or at least for Tesla, it's still in a downtrend. So by selling a covered call, you're capping your upside, but I don't see a near-term catalyst that will push the stock price up again like so soon. So in terms of vertical spreads, the bulk of my funds in my options trading portfolio comprises my vertical spread position. So at this time of the writing, the below are the open contracts that all of them are bearish bets. So he has vertical spreads on Tesla, on SPY, on Nvidia, on Netflix. So here's my problem with vertical spreads. You're basically betting on a direction. And like I said, betting on a direction in the near term, nobody knows what's going on. If you're trading, then okay, kudos to you. You are using technical analysis, you are using all the EMAs, your Fibonacci's and whatnot. Then you need to know that, to me, I think trading actually is half investing, half gambling. To be very, very honest, because you are taking a directional bet. When you are going into this trading thing with all this directional bet, just know that you are okay with blowing the entire account up. I think that's my baseline. So as long as you are okay with losing everything, then I guess it's fine. It's your money. I have no comments about it, or I can't control what you want to do. So in 2022, I set very little money aside for emergency funds as I YOLO most of my money into options because I wanted to generate more money from options. So thinking back, it was quite risky as I would end up with nothing if the stock investments or options trading failed. So with these 100,000 emergency fund, I can rest assured that I still have some money to sustain my family's livelihood, even when it hits the fan. I hope this sharing is useful to you, and I encourage you to review your portfolio yearly and plan ahead so that there is still a chance to rescue your portfolio. If you leave it on its own, the losses may compound until a point of no return. I wish you all a fruitful and successful investing year in 2023. All the best. I think one key area of lesson that we can learn here also is thinking back, it was quite risky as I would end up with nothing if the stock investment or options trading failed. And the main objective of the main idea on why he wanted to go into Leap's portfolio is because he wanted to generate more money from options. And this idea of going to Leap's call, you're basically leveraging up your portfolio by, I don't know by how many magnitude. So many people also recently have been laughing or have been commenting or criticizing people. I have a separate guest on this channel, which is Master Leong. So Master Leong actually also used margin, which is he 1.5 times his portfolio on Alibaba. And when Alibaba was just selling down, he was basically margin called and he was forced to sell some of his Alibaba position. So in this case, actually personally for me, taking on margin or using options or going to leaps, to me, they're all leverage plays. So it's just that for one, for margin, if you actually have the money, you can top up into your account so that you can maintain the maintenance margin. While leaps, on the other hand, as long as you enter the position, as long as the market goes south, you have no recourse. You can't get back the money because it will just keep decaying. Time will decay, the options value will decay, and if the share price just keeps collapsing, then everything will just decay together. So in this case, I think the biggest lesson we can take away from here is having a $1 million portfolio. That's actually already extremely, it's a huge amount, it's a huge quantum. But at the same time, Jason still wants to generate more money. So it then plays into this idea of the innate nature of human greed. And I would just like to caution everyone that, of course, albeit we all want to earn money in the stock market, we have to manage the downside. So for me personally, I like to find outsized bets. And going very heavy into Chinese tech, I have many comments online saying that, I'm gambling, I'm extremely risk-taking. I'm going all in into Chinese tech. You don't know what China will do or what Chairman Xi will do or what CCP will do to all these companies. I see all these risks in a different light. And many of these concerns or many of these risks don't seem to faze me. It faze other investors, which is why many of them are selling down the investments. But to me, I don't see the same level of risk. So I think In terms of managing risk wise, all of you should know your own risk profile and all of you should manage your risk accordingly as well. So I think with that, I hope you guys enjoyed the discussion and be more kind with your comments below. And I think there are many lessons that we can learn here. So with that, I'll see you in the next video. But more importantly, I will see you on the moon. Goodbye.